Let us look back at India in the late 90s and early 2000s and think about Indian banking. SDFC Bank and ICICI Bank started out as small banks and slowly redefined how millions of Indians think about savings. How two private banks went on to become two of the largest banks in terms of market cap listed in the Indian stock market. Now imagine being an investor who spotted these changes early before they hit the mainstream, or spotting these stocks early when they were mid or small caps. For example, HDFC Bank grew its market cap over 230 times in 24 years and ICICI Bank grew its market cap 14 times in just 17 years. So this is the kind of growth story you could be a part of. Every now and then, some themes emerge. Such chances are rare. They come once or twice in a decade. And when they come, they don't come with noise. But if spotted and picked early on, these could prove to be game changer for investors. But here's the truth. Most of the investors recognize it too late, when the big moves have already happened, when the stocks have peaked. But now what if I told you one such golden opportunity in a theme which is quietly being built across India and most of the retail investors have not even noticed. So the theme is early, but it is promising. And for an investor, this is where golden opportunities might hide if you know where to look. And that is exactly where I come in. I am going to break down this golden emerging theme in this video, so you will know exactly how much potential this sector holds, how it is evolving, and most importantly, how as an investor you can benefit from it. So in this video, I am going to explore the golden stock opportunity in this theme. Now let's get started with something we already know. India is consuming more data than ever. Every month we consume 26 exabytes of mobile data. Now that is the same as China and nearly 3 times that of the United States. So while we are consuming data like crazy, India's data center capacity stands at only 877 megawatts. Now compare that with 15,930 megawatts in the US to 8,300 megawatts in the Europe. We are operating at less than 1/4 of China's infrastructure strength. So we have this massive gap. On one side, we are consuming data like never before. On the other hand, we are severely undercapitalized in terms of infrastructure to handle it. But there is a golden rule in investing. Where there is a gap, there is an opportunity. And this gap is the data center revolution. Now, why should you care about it? Because closing this gap is going to create wealth like we have never seen before. So here is the math. Building a data center in India costs roughly 45% lesser than the world average. The land is cheap, the labor is skilled and affordable. The regulatory environment is improving, and there is a huge government tailwind for this sector. So in short, it is a perfect storm for growth. Let me show you how dramatic this growth is going to be. The first commercial data center in India was set up in the year 2000. Now in the next 10 years, it grew at a snail's pace, reaching 122 megawatts. Now that is an average addition of 12 megawatts per year. But now, with the rising demand, the data center capacity is expected to grow at 30% per annum, reaching 2000 megawatts by 2026, with an investment of 50,000 crores over the next 3 years. Colliers is expecting the footprint to expand even further to 4,500 megawatts by 2030. The Indian data center market is itself expected to grow to $27.2 billion by 2032 at 14.6% CAGR. Now this is not hype. This is infrastructure transformation, And once these data centers are built, revenues will come in like clockwork, steady, predictable, growing. Now let's talk about who is going to capture this opportunity. Now there are many players in this space: Netweb Technologies, Techno Electric Engineering, E2E Networks. But one company stands out as the most compelling opportunity right now: Anant Raj Limited. Most of you know Anant Raj as a real estate company, and you're right, it has been in the real estate business for over 4 decades. But what's happening right now is a complete transformation. The company operates in three main segments. First, traditional residential real estate business with over 11 million square foot of ongoing projects in Delhi NCR. Second, stable commercial real estate portfolio of 1.92 million square foot fully leased with long-term agreements. But the third segment, now that is where the magic is happening. Anant Raj's data center and cloud infrastructure arm currently has 28 megawatts of operational capacity. But here's the kicker: they have a roadmap to scale it to 307 megawatts by 2032. Now that is a tenfold expansion. To signal their seriousness, the company recently raised 1,100 crores through a qualified institutional placement and announced a 4,500 crore investment in a new data center in Andhra Pradesh. So this is not their side project. This is the company's future. And the numbers, they are impressive. Revenue CAGR over 5 years stands at 69%. And in Q2 of FY 2026, revenue grew 23% year on year to 630.79 crore. So for the first half of the year, revenue was up 24.22% to 1,223.20 crore. And the profits have also gone up, with PAT growing 30.79% in the second quarter and 34.28% in the first half. And the EBITDA margins expanded by 415 basis points to 27.76% with a healthy PAT margin of 21.56%. But here is what really matters for the investors. Their balance sheet is fortress-like. Anant Raj has moved from 1,494 crores of debt in FY 2021 to a net cash positive position today, which means that they have the financial firepower to execute their ambitious roadmap without diluting the shareholders. For an investor with 3 to 5 year time horizon, this is compelling. Yes, there is execution risk. Yes, the competition is increasing, but the growth potential, it is a multi-bagger territory. And the moment people hear the word multi-bagger, something dangerous happens. Logic switches off, patience disappear, and the investors jump in with huge money without thinking twice. Now that is exactly how good stocks can turn into bad investments. Take Anant Raj for example. Yes, it can become a multi-bagger. Yes, it is a strong business. But the real truth is, how you buy matters far more than what you buy. See, there is always a right way to build positions in any stock. You don't start with excitement, you start by understanding the technicals. You ask what the chart is indicating right now. And on our website RangaOne.finance, under the Why Buy This section, we had clearly mentioned that Anant Raj was trading near a strong support zone of 477 rupees. And at such levels, building positions gradually makes sense. But even then, going all in is a mistake. So in our multi-bagger portfolio, we added Anant Raj exactly the way professional investors do it. We did not deploy huge capital at once. We started with a small allocation of 1 to 2%. And most importantly, we did not stop at telling the clients the percentage. We told them the exact quantity to buy it. So this is the difference between generic advice and real executable investing. So on our platform, you will also notice the action column, which tells you exactly what to do about the stock, whether to buy, hold, add more, book profits, or exit. No more confusion, no more guesswork involved. And next month, we are taking this even further with our investment calculator. Clients can simply enter the amount which they want to invest in the investment calculator, and the system will automatically calculate based on proper weightage. And if you change the investment amount, the quantity will also adjust instantly. So Anant Raj is a strong stock, but it is still a small cap. Knowing when to add more, when to book profits, and when to stay patient. All of these updates, entries, additions, and exits are systematically shared on our new website. So if you want to invest calmly, logically, and professionally, you can join RangaOne Finance. The link is in the description. Now I want to talk about another stock that has got my attention. Netweb Technologies India Limited. Now Netweb is not a traditional data center company. Think of them like builders of extremely powerful computers, not for home or offices, but for governments, AI researchers, scientists, space agencies, and large enterprises. They are into high performance computing space. And their fundamentals, they are amazing. FY 2025 revenue reached 1,149 crores with a 66.6% CAGR from FY 2022 to FY 2025, and the PAT CAGR stands at 72.1%. Now that is consistent profitability expansion, and the operating EBITDA margin is 13.9% with a PAT margin of 9.9%, and their customer base is strong as well. 90.7% are repeat customers with an average relationship of 4.8 years, and the top 10 customers represent 49.5% of their revenue. But there is diversity across government, defense, education, BFSI, and enterprises. So this reduces concentration risk. So why am I cautious about Netweb Technologies despite the stellar fundamentals? See, here's the thing. When a company makes profit, the owner takes the dividends and the salary. But as a retail investors, you make money only when the stock price appreciates. Just by looking at the sales and profit growth, we should not invest. Investing at the right price is important for us. And right now, Netweb Technologies is trading at a PE of 140, and that is extremely expensive. Now, I know what you're thinking, but the growth rate justifies the high valuation, right? Well, even if you look at the PEG ratio, which adjusts the PE for growth, it shows 1.95, indicating an overpriced stock. So here is my stance. Netweb is an excellent company, but right now it is available at an expensive price. So I'm just keeping it on my radar. When it will be available at suitable levels, I will be building positions. But right now, the risk to reward ratio is not in your favor. So that was me analyzing the golden opportunity in the data center theme. And as always, if you have any doubts, put them in the comment section. And this was Sanika from RangaOne Finance, and I will see you very soon in the next one. Till then, bye-bye.